At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing. We chat with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, I'm delighted to have Frank Tanner of Morgan Creek Capital join us. Thank you, Frank.
Thanks, Tim. Great to be here.
Frank, you started at Morgan Creek around 2013 after graduating from UNC, and at UNC you played some basketball. What ultimately drew you into Morgan Creek and venture capital?
Yeah, I mean, like a lot of folks that make their way into this industry, it wasn't by design or plan, but it was kind of a chance encounter. I met Mark Yusko, our CIO founder, while I was still in school. I was a walk-on the basketball team. So through that connection, we got to know each other. And then right out of school, I was offered the position. It's not a typical, hire out of undergrad, but I was lucky enough with the help of Mark to come in under his wing and learn kind of the private assets business from the ground up. So I started as a journalist covering all asset classes, within private, real estate, energy, buyouts, venture growth, you name it. And then over time, have gravitated kind of both with the strategic direction of the firm and then also personal interest in some of the observations we made around, the return potential within this specific asset class, venture capital. We kind of gravitated towards the asset class and continued to build a program focused on that space. And 12 years later, here I am, and a lot of different, experiences within the same firm, but it's kind of been a really rewarding place and good fit from the start.
Let's talk about basketball real quick. What type of basketball player are you? Shooter, forward, center, scrappy, Ron Artest like Dennis Rodman, or what type of player are you?
I'm a shooting guard, and I wasn't always, a guard, but it's a funny thing. I guess you make this observation as you graduate through the different levels of competition. But I stayed the same height, but I got smaller and smaller over time. So when I was in high school, of course, small forward. When I'm going against, folks 6'10", 6'11", I'm a shooting guard, and fortunately, there was a good fit there on the team. So mainly, knew my zone around the 3-point line and kind of stuck to that.
I like to play pickup basketball, and I believe that basketball and how you play basketball reflects on your character in some ways, and on like how you play the game and how you actually. Are you a passer? Are you a shooter first? Are you a skill player for scrappy? How much do you think that's the case or not? Or am I extrapolating too much?
Yeah, there's. You have to be good at something to earn a spot on the floor. You can be a defensive specialist, aka not a good scorer, but people can really shine in that. You can be a rebounder. You can do. Very rarely does someone do everything at the top level, and if they do, they're usually make it to the NBA and shine there. But I was, had my gifts and had my weaknesses, and shooting and, kind of hustle grit was where I shined. Again, this is kind of back in the day at this point, but you have to specialize. And I think there's a lot of maybe analogies kind of to draw with, specialization on the court and then specialization in investing. So whether that be some domain expertise, you're really deep on a sector, you're really deep into a network, you have maybe a brand or specialization around being known or adept at a certain type of investment, certain type of businesses, that goes a long way. So that's something that we, kind of intuitively look for, and both when you were playing basketball and now kind of in the investment world.
I want to go back a bit more into basketball. You played basketball at UNC and you were a walk-on, is that right?
That's right. Yeah, and a walk-on, for the listeners not familiar with the term, you're just non-scholarship player. So had the opportunity to pay my way through school, old-fashioned way, working jobs. So had a couple jobs. Had a year off my junior year and then walked on my senior year. And yeah, it's a bit like portfolio construction. When the coaches build the team, you may or may not have an opportunity to walk on because the slots might be filled. But senior year, that opportunity came around, so I stayed in shape on my own and stuff, and tried out and made it. And I had an older brother that did the same. Played his final 2 years, a few years ahead of me. But it was a huge opportunity for a walk on, an experience like you can't get anywhere else. And yeah, fortunate to have had the opportunity.
When I think of UNC basketball, I think of, and I'm dating myself, Eric Montross in the 90s, I believe, and then obviously Dean Smith. And then there's Coach Roy, I forgot his last name. Which coach did you play under?
I played for Roy Williams and graduated in 13, so I was the 12-13 season. He had been my brother's coach from '07 to '09 as well. They had the championship team in '05. But yeah, it's a long history of greats that came through the program. So yeah, fortunate enough to have been a very small part of it.
Yeah, it's impressive in terms of just walking onto a basketball team, especially UNC. That's not something you can just do. Mad props to you. You had dropped a few references or analogies to basketball and investing in venture. And I'd be keen to hear more analogies because I'm sure you've been thinking about this. And so, any more you want to share?
So yeah, one of the analogies I like best, and I'm kind of going to borrow this from our CIO, Mark Husko, but when you're constructing a team, it's a bit like picking a portfolio. You select the best talent and put them on the floor, and there's, especially for like a fund of funds, you diversify, you match strengths and weaknesses, kind of offsetting characteristics, and through that you build a winning portfolio, a winning program. Same thing with constructing a portfolio, so to speak, of players that you put out on the floor. So the coach isn't, playing defense, getting the rebounds, boxing out, taking the 3-point shots, but they are putting the players that they feel in aggregate make the best team and give the best shot at winning. So I think there's a lot of similarities there, and kind of constructing a portfolio and talent, and how that not only kind of plays or shines individually, but how it works together as a unit. The other one, and maybe the most obvious, is just work ethic. There's a lot of work, and this. If you've been in the industry or have put blood, sweat, and tears into any passion or project, you know this. But there's endless hours of work that go into kind of the final presentation or whatever you're trying to achieve. So what that looks like in basketball, 200 to 500 made shots a day, just practice on your own, weight room, conditioning, all that goes with it. What that looks like in investing, 500 calls with GPs a year, all the data that you have to unpack and distill down into a few funds, manager, GP selections a year, and then some co-investments alongside that. So kind of the final product that you deliver in the investment world is just maybe the tip of the iceberg, so to speak, of all the work that went into it. Just like basketball, you see 2 hours of play once or twice a week, but that's the tip of the iceberg relative to the thousands of hours that went into it.
There's two things you said there that I want to double click on that I find fascinating. First is how fund managers are analogized to coaches. And I think that lately within venture capital, a lot of the coaches have been player coaches. And I think that's also the case now with NBA and NCAA. So Dean Smith and Coach K play basketball, but increasingly we see like people who have played a ton of basketball, like Steve Kerr, take on those coaches. And I think that's also the case in venture. Any thoughts on that?
Yeah, that's taking the analogy a little bit further. Yeah, and not to torture it too much, but yeah, there is a lot of similarities, like with operators that become VCs, and even I've seen some scenarios VCs become more kind of an allocator investor role. So Yeah, there's learnings that you can carry over. There's shared kind of lived experiences that you can build rapport with and resonate with founders or whatever layer of the ecosystem you're operating in. And yeah, I think there's a balance. I think like if you're too much of a buddy to the players, you forego some of the authority perhaps that you need to to implement sometimes or carry as a coach. But yeah, there's a spectrum, right? So just like fund managers, there's some really good market participants, so to speak. Everyone wants them on the cap table. They're a small check perhaps, and then there are folks that maybe are more of a coach, more experience, can come in and give you a lot, of advice and guidance, sit on board, and less so of a market participant, more so of a kind of mentor, if you will. So.
I won't torture this analogy, so this is the last time I'll use it. But the second point quickly was that you all invest in coaches, and I feel the larger a fund gets, the more they become less coaches and general managers. And there's just so many aspects that they have to manage beyond just the players on the court. And so that goes to my question, which is you all invest in keynote VCs, and those are emerging managers, sub 300 million, and sometimes smaller. What defines a keynote VC for Morgan Creek?
Yeah, the keynote VC is a term that we coined a few years ago at this point, and really we were searching for a way that encapsulates, what a potential, tier one from a return standpoint GP looks like at the early stage. And the way that we characterize it, simply, someone with strong, founder NPS, we call it founder resonance. They don't necessarily see every deal, but their network, their relationships serve as kind of a filtering mechanism for part of the ecosystem or asset class that we want exposure to. So there's a gravity around or magnetism around these VCs, and we think very much that early stage venture is distributed. We're talking, when you say early stage venture, first check, pre-seed seed investing, and we think it is distributed, that because there's a strong kind of human element to starting a company, collaborative ideation, nature to startups, and that's really difficult to, industrialize, if you will, and have a brand or platform kind of transcend that very human element. So yeah, Keynote is simply, small early stage founders. We say sub 300 million, usually they're sub 100 million is where we play. Sweet spots probably as low as 10, but more like 20 to 40 or 50 million in fund size. And they just have really good rapport, NPS with founders.
For the VCs that you all invest in, what's an okay fund in terms of returns, and what's a outstanding fund in terms of returns? Is it like you all want 5x net, or is it 10x net? Like what type of returns are you looking for?
Yeah, so the way we think about this is maybe a little bit different than maybe most LPs. When you look at kind of portfolio allocations, modern portfolio theory, you need variance, some element of risk in the portfolio. There's not that many places in terms of asset classes where you can achieve that level of volatility. And one of the few places that it does exist is venture capital, specifically early stage. So when we think about kind of the band of potential returns, 3x on average is a good return, right? 3 to 5x. But it's a little bit more nuanced than that. If every fund we back did a 2x or 3x, that might get us there, but that's not how we construct the portfolio. We understand there's more risk with smaller funds. Just like building a portfolio of early stage startups, these early stage funds carry a bit more risk than, say, a growth strategy. So we do expect some of those funds to not pan out potentially. 1, 2x is kind of the downside. But where it gets interesting, and this is mainly because of the power law and the exposure you have to it with this portfolio construction, with this, slice of the market, these funds can achieve 5, 10, 20 plus X returns. And we've seen that with some of our managers over the years where because they have outsized ownership in the companies they invest in relative to their fund size, as an LP, you're more exposed to the upside. So what that looks like is, a portfolio of, a lot of maybe 2, 3X kind of returning funds. But then those outlier 5, 10, 20X type funds. And I think that's distinct from some of the exposure you get investing purely into some of the larger scaled funds, some of the platforms, certainly growth equity. And so it's a way to implement risk in a thoughtful, kind of intelligent way within a portfolio.
Let's talk about portfolios. We've had Charles Hudson, a precursor, and he builds portfolios of 80 to 100 players. Then we talked to Jamie of Screen Door, who was at Virtus, and they like portfolios with there's 50 investments or 50 players. Does Morgan Creek have a point of view on portfolio construction and size?
We do, and I think the world of Charles and Jamie. She's put out some of the best research I've come across on some of the portfolio construction. Every LP is different. For us, we land a little bit different spot on the spectrum. So we do agree that larger portfolios, because of the nature of returns in venture, where mean returns exceed the median return, there's a skew to the return. So there's a benefit to building larger portfolios, right? So theoretically, if you can take the mean of early stage, it's actually a really good return, actually theoretically and empirically shown in over decades of early stage data. So what does that mean in practice, right? As a fund of funds, you could, back 5 managers. They all have 50 companies within the portfolio, 250 underlying companies, or you could get to 250 underlying companies by backing 10 managers, and they all have 25 companies. We think, and to my point earlier about how it's a very human-centric, one-to-one, kind of bespoke, relationship-driven industry, there's diminishing returns with larger portfolios for a single GP, right? So a GP that can write a check into 20 companies presumably would have higher conviction than the 99th company that another GP is writing a check into. So we try to get scale through a portfolio of managers writing checks into companies that we think scale up into their kind of degree of conviction in those companies. So usually that lands around 20 to 30, maybe up to 50 in the more diversified portfolios. Again, that's more of a market participant model in our mind. But yeah, we try to get surface area through multiple allocations to funds, as opposed to having one manager making that incremental bet on the founder he's less close to or she's less close to, with marginally, incrementally less conviction than the first investment they made.
Given how early the fund managers you're investing are investing in, and given the number of checks they're writing, I assume that their follow-on and reserves are on the smaller end. Do you all have a point of view on that or not?
We do, yeah. We tend to skew less reserves than more. Again, everything depends on the fund, right? So I don't want to box us in too much here, but some of the larger funds, meaning 50 plus million, 30 plus million, might have a little bit more reserves. Also depends on how early they're investing, how close they are with the founders, what their model is on the value add side. Some of the smaller, earlier funds, say you're a $15 million fund doing pre-seed, just get as much ownership as you can up front at the best valuation, and then be happy with that exposure, get an incremental bet or two in the portfolio, and that's how we what we think is optimal for kind of earlier stage, smaller funds.
Do you all like to take LPAC positions or not?
We will. It's dependent on the situation, but we will if it's mutually agreeable between us and the GP, which we've been on many LPACs over the years.
And then do you all have a percent ownership that you are looking for within your fund investments? Because most of the guests we've had is like 10% is where they cap out at.
Yeah, we actually don't think about it that way. We underwrite each fund to a net return to us. So we're not necessarily thinking about what our ownership is and look-through ownership is, just given that each fund model is slightly different for the underlying GPs. So we underwrite to a net return and then see how that blends together for our overall return. And but we do have strong views on underlying ownership for the GPs.
What do you think the GP's ownership should be within their first check?
Yeah, generally we, and this is the $1 million question, but generally in rule of thumb here, 10 to 20% of the fund size is what we look for in ownership. So if you're a $50 million fund, that's 5 to 10% ownership up front. And with dilution, with a billion plus outcome, kind of using those assumptions, if you're a first check into a unicorn, we like to think it's material for the LPs. That gets you in that ballpark of returns half to 2x the fund as kind of a base case, right? And then you have one or two, so the hit rate in the portfolio matters as well. But you have one or two of those outcomes, and that gets you to that 2 to 3x fund, and then you have the rest of the portfolio as well. And then where the upside comes is the degree of success or how large the outcome is, and less so of whether or not you got the ownership. So in return the fund math, there's lots of ownership levels that work, lots of assumptions you can make to make the math work, but we generally land 10 to 20% of the fund size. Said differently, yeah. So anyway, I'll leave it there. That's kind of how we think about it.
I would say the more experienced investors I meet in venture, the more they are obsessed about ownership, and that obviously you want as much ownership as possible in your winners, but it's a balance between how many checks you can write.
Maybe can I jump in there?
Please.
Yeah. Maybe on that point, and this is such a great example, and I think for a lot of early stage investors like micro VC, allocators, LPs, they're questioning the return the fund math because we just saw Figma IPO and incredible outcomes for a lot of the top tiers there, right? Sequoia Index, Greylock, blanking on the other, but yeah, overall, I mean, like each of those funds, back of the envelope have returned the fund and more, anywhere from 1.5x to I think 18x was the biggest return on the fund with that single investment. And then I think the interesting point though there is that the ownership relative to fund size was actually pretty good from the funds that they invested out of. So I think maybe index, I might mix up which fund was what percentage, but I think they were 5% of their fund size. So yeah, with dilution, it's completely expected range, right, of ownership. And if the fund size was 400 million, so I think they were 16, 17, 18% ownership or so at exit. And the math works. Also, it was a really great outcome. But I think for early stage investors, if they're also exposed to those outcomes and they have better ownership relative to fund size, you're even more levered to those, generational type returns.
You had mentioned at the beginning of this interview about being a fund of funds. We recently interviewed Akar Vachani at Fairview, and they're a fund of funds. And one of the topics we talked about was how difficult it is for fund of funds to raise money. And GPs sometimes, to many times, have obstacles, especially emerging managers with raising capital. What's your fund of fund viewpoint on raising capital?
Yeah, I mean, it's we're kind of in it together, right? We're not, no one, um, unless you're a top tier fund, has people beating down your door to give you capital. I think it's a bit of and we're completely comfortable with this stance, but it's a bit of a contrarian, non-consensus view to be so heavily investing and committed to this part of the market, which is micro VCs, early stage, pre-seed, seed. If you look at the data, it depends on the year. Last year is very similar to the start of this year, but it's, the top 10 funds have accounted for over 50% of LP dollars raised. So it's a bit perplexing to me in that there's, I always hear everyone say, oh, early stage is the place to be. And then you see the actual behavior of allocators, and a lot of the capital is still concentrated, which, and it's kind of like the saying, I've never met a VC that's not top quartile, at least in the pitch. But yeah, so I've never, met a fund or an allocator that didn't preach early stage, and then, what does the behavior say? So yeah, it's not easy, but I think, we advocate for the space. We make a data-backed case. We've built an engine, if you will, and have the reps, 20 plus year history at Morgan Creek to underwrite into this part of the ecosystem, and we're dedicated doing it. So the I think this is where investors will be rewarded over the long term. But time, you got wait, and time will tell, and how that looks. So so fundraising, we're all in it together. It can be a slog sometimes, but I think that might be a good a good data point sometimes if there's money not flowing too easily into an asset class.
I think certain times GPs can forget that LPs also need to fundraise, and that's not something I fully appreciated until after my final close on the first fund. One thing I really like that you have mentioned a few times is your S framework, specifically source, select, secure, support, and signal. Can you break down how this framework gives you a view on manager quality and what unique signals within that model you believe other LPs might be missing?
Yeah, so it's a really first principles approach that we've developed to underwrite early stage managers. And if you look at Morgan Creek's track record, 60+% of our fund commitments across all asset classes for 20 plus years has been to emerging managers, funds 1, 2, and 3. The benefit that, say, traditional private equity buyouts has over venture is that there's a diligenceable, if that's a word, track record that you can look at. You can validate the strategy. It's very deterministic in the outcomes that you're underwriting. Whereas venture, there's such a lag in returns that you have to wait sometimes 5, 10, decade plus to see those validation points. So what you're participating in is not what you necessarily underwrote going forward. So the 5S framework: source, select, secure, support, signal. It's kind of an expanded view of CPIC win, which most of the venture industry knows, but we add in there signal, which is a more nuanced kind of take on something that we think is very important in how network driven the venture industry is. And that signal basically means, the best way that I found to kind of characterize this and articulate it is that the VCs we back are somewhat of a tastemaker, a validation point. Some of these are a little bit strongly worded, but essentially the investments that the early stage venture manager makes matter in the broader context of the venture community, right? So solo GPs can carry great signal in this way because they're so clearly kind of defined as what their type of deal is, what they like, what they don't, where their expertise and domain experience is. And so, say a solo GP makes an investment, downstream investors might take note. So and where capital is an important factor in the growth and scaling and getting to that escape velocity, I think the signal is an important point that we try to articulate in our process.
I used to tell folks that were interested in venture or explaining venture that it was a triathlon. You have to fundraise, then you have to source, then you have to select. But now with these five S's, I'm thinking maybe it's a pentathlon or another form of Olympic event. One thing though that I feel like should also be added in your S's is sales, because I don't think you can do source and select without selling. Thoughts on that?
Yeah, selling is a core function, I guess, for the VC to raise the fund. I think sale, I mean, there's another interpretation here as well, like sale as an exit. When do you sell the company, right? So we, in our underwriting, capture this in the select S, right? So you have to select it initially. You have to continually select it with each opportunity you have to sell. So I think that's and I'm not the first one to say this, but every time you don't sell a position, you're re-underwriting it, right? So yeah, but yeah, I mean, everyone's a salesperson, just like a founder, right? They're a salesperson almost first, and then yeah, just like a VC has to be, right? So that's a good one.
In terms of venture as an asset class, you've said that it should be more of an evergreen allocation. Why do you think it's risky for investors to sit out vintages, and how long do you ride with funds that you invest in?
Yeah, vintage diversification is critical in our mind, right? You have to have continuous exposure just because you don't know which vintages beforehand are going to be the ones to outperform. And when you take a diversified approach, your returns are maybe less idiosyncratic for that asset class than someone who's just doing a one-off like early stage fund. So yeah, vintage diversification is key. The other important point here, investing across, vintages is that you have to have continuous kind of investing in tie-ins, into the network. So just like a venture capitalist has, some half-life to their networks with founders, same thing with LPs, right? If you step out of the game, you can't tactically come back in as you wish and maybe have access, know the right VCs that are up and coming and new, and the Sequoias of tomorrow sort of thing. So yeah, it's a asset class you have to continuously invest in to play in this space, but also just given the uncertainty around which vintages are going to outperform.
And then in terms of investments into funds, my understanding is you all are fund one, fund two, fund three. But how far have you carried a relationship?
Yeah, we've done, I mean, the largest or latest stage fund that we've done, not from the current early stage vehicle, but in past has been fund 9 or so. So like there's been situations where either a client or a more diversified program of ours wants to make a commitment. Our current program of investing in early stage is very much focused, on that primary slice through the market, pre-seed seed. We actually are not an emerging manager mandated fund, but it's where we find the best alignment typically, and it's been a more organic kind of expression of our convictions, and yeah, it's kind of what's manifested over this more bottoms up approach to underwriting and investing. So funds 1, 2, and 3 make up 90% of the current fund. We have several fund ones in there as well. We will continue on fund 4 or 5 and beyond, but typically the manager maybe graduates out based on fund size, stage, et cetera, or it might not make sense.
You all not just invest in GPs, but you also will do co-invest or direct investments. Can you talk through your strategy and approach on those investments?
Yeah, we do a fair amount of co-investing. It's evolved over the years, right? So we've co-invested across all asset classes. Within venture, it's a little bit trickier, just given the adverse selection risk is much higher than some other asset classes. So the way that we kind of protect against this or account for it is primarily just sticking with GPs within our current fund, where we have visibility on the portfolio for several quarters in advance, a year in advance before we're shown the opportunity. And yeah, typically we're investing at the seed plus kind of A stage, strategically right size, so we're not disruptive in the round. The pro rata or super pro rata check can be meaningful for us, but yeah, where we try to avoid are the overheated rounds where we're trying to being sharp elbowed with some of the more value add or larger top tier investors that are dedicated in venture, and try to play nicely with our GP, with the cap table, and we've kind of found a good sweet spot there.
How long has this co-investment program been around?
Yeah, since pretty much day one, we've been co-investing. So 20 years, we've been co-investing both from our diversified fund of funds on behalf of clients, and then yeah, we'll do some later stage investing, a little bit larger check sizes into maybe pre-IPO growth stage rounds, if things line up to make that happen.
Has that percent of co-investments increased over the decades, or has it stayed the same, or what is
It's
that
pretty
percent?
yeah, it's pretty consistent. We're anywhere from 10 to 30% depending on the vehicle vintage, but yeah, it's pretty consistent in that we're fund underwriters first, and then we've stood up other businesses and practices within the Morgan Creek umbrella that more are more focused on directs and co-investments. But yeah, I think a lot of our convictions and underwritings lie around kind of that distributed keynote network that we're trying to access and back first and foremost.
You brought up a few minutes ago about the bifurcation of venture in the sense of some larger funds getting really, really large. What recommendations do you have for micro VCs or future keynote VCs in terms of navigating this current environment?
Yeah, I don't know that I have any super sage advice that is going to solve all problems, but I do think about this a lot just in terms of our underwriting and our own business is one of the key risks that we face, and hardest things to underwrite is partnership risk, or if it's a solo GP, kind of the GP going on to do something else. And we see it time and time again for different reasons, almost none of which you can foresee at the outset without some really deep questioning and getting to know the GP well. So how that reflects back on the GPs, I would just, have really strong introspection and say, why am I doing this? And it's the question that we ask, right? Like, how does venture capital, this fund, fit into your kind of life journey, if you will? And it's that big of a picture for us, right? Because the smallest thing, some of these new partnerships can be so fragile. And if it's a philosophical difference, if it's a kind of opportunistic, synergistic, kind of convenient time to set up a fund because I had some good angel investments, but I'm thinking about doing something else in 3 years, that's really hard for an institution to get comfortable with. So yeah, I think why now, why me is something that we like to think about a lot in our underwriting. So I think if you can answer that question, and I think there's really good answers to that question as well. So that's something that we think a lot about.
You've dropped solo GPs a few times in this conversation. Over a decade or two ago, very few, if any, solo GPs, but the past 5 to 6 years, somewhat of a explosion. Has your exposure to solo GPs also coincided with that, or relatively staying away from that?
Yeah, we do a lot of solo GPs. So I would say we have more exposure than we did 5-10 years ago, certainly. I would say like the classic advantages, disadvantages, I think we all are familiar with, right? Decision making. I think like if you're a solo GP, the market knows what types of deals you do, and that's like immediate, signal or taste making that the market can pick up on. I think you're able to adapt more quickly to changes in the market. You're able to build conviction faster. But there's drawbacks too, proverbial bus that can knock out a partnership, et cetera. But yeah, so we don't underwrite specifically on those two vectors, just like we don't underwrite on emerging versus not. We don't underwrite on some of the more traditional kind of vectors that LPs think about. We do the 5S framework and try to build conviction kind of bottoms up that way.
We haven't talked about AI yet, and AI is dominating the headline every day. I'm curious, how do you all think about firms and your own co-investments within AI, or are you all thinking of other industries, and how do you balance that?
Yeah, we're diversified, so we certainly have a fair amount of AI exposure in our current portfolio. Something we're excited about. I think there was an analysis done a week or two ago around how big each wave has been from PC to internet to mobile to cloud, now AI, and it's basically 3 to 4x each wave. So we're looking at, I think their analysis was 21 trillion kind of value created in AI, and versus 3x smaller each predecessor a wave. But so we're big in AI already, and we'll continue to invest in that space. I think the future is unwritten at this point. So I don't like if anyone tells you what it's going to look like. I think they're speculating like all of us are. But we can point to specific examples in the portfolio of like we know that when you pick up the phone and talk to a health clinic, you're going to be speaking with an AI. And that's coming, and it's very soon, if not already here. So we know the specific use cases, or some of them now, but I think there's thousands more that is really exciting to us.
We're going to close with some rapid fire questions. Favorite travel spots?
Oh man, Acadia is a really fun spot. My family and I like to go. One, it's easy to get to for us being on the East Coast with a 5 and 2-year-old, but we're huge fans of national parks.
Favorite movies?
Favorite movies, a long list. I would say Memento is probably one of my top ones, and I guess same class like Inception was a really good one. I'm excited about the Odyssey. It's coming out. So
Christopher Nolan's an incredible director.
Yep.
Favorite treats or snacks?
Probably dark chocolate, coffee, beef jerky. There's a really good beef jerky spot called Riley's Jerky if you want to check it out.
Frank, this has been a fun and very informative discussion. Really appreciate you taking the time to chat.
Thanks, Tim. Really enjoyed it.